Hi, I wanted to go over an example for risk management regarding credit risk and credit card loans. So, what is credit risk all about? It's really about limiting your credit exposure when you have lent money out. Now, what does it mean to limit credit exposure? It basically means when your loans are outstanding to reduce the losses. So basically, when we have something like this where we have loans outstanding, I took an example of credit card loans here. So with credit card loans, what is going on? We have a loan amount outstanding, we have an interest rate, and we have a FICO score, which is the credit score of the borrower. What is the idea? I wanted to show you a model to show you everybody knows that credit card loans, the interest rate is very high. So the idea is, what if I wanted to ask you, how much can the banks lose on defaulting loans in the credit card space and still make money, right? And still make money. So how do banks make money on credit card loans? What are the driving factors for the credit card loan? So you have to basically limit losses. How do you do that? By basically limiting the default rate. And also charging a certain rate, charging an interest rate that is enough to cover all the expenses that go with the defaults. Why is the credit card rate so high? Because these loans are unsecured. Unsecured loans. You know, this is not like a mortgage where it's fully secured, like by the house value. When you don't pay your credit card, they're not going to come out and take anything from you. These are unsecured loans, and that's why their rate is so high, because there is a certain higher non-performing rate for these loans. So I will provide this to you as well, the schedule, and I invite you to play with it a little bit to get comfortable. Say you're a risk manager for a bank, and you have to operate this portfolio. So for example, I have 10 loans here. And FICO scores, like, from what I understand, like below 600 is average. 600 to 700 is good. No, 600 to 700 is average, and 700 and above is good, and below 600 is below average. So how do they limit the exposure to low? If you have a lower FICO score, they do less of a loan. So you'll notice here, for the lower scores, I just put a lower limit. Isn't that what they do? If you have great credit, they give you a high limit. If you have a poor credit, they're just gonna give you a loan of 2,000-3,000, and they're gonna say, hey, the most we can lose is 2,000 to 3,000. So how does that play out in the big scheme of things? I said for these 10 loans, a total of 37,000 at 24.3%. If all the loans are performing, this is how much the bank made in the first year, 8,900. Second year, some of these have defaulted. And notice when they default, they still have a certain recovery rate. So even when people can't pay, say they don't pay for a couple months, right? But then after a while, they either settle or they make a payment plan and they pay at least part of the loan off. Usually the settlement is for about, a recovery is about 50% for these kind of loans. So this is how much they make in the second year. Some loans are not paying the interest anymore, so they're making less. And these are the total losses. And now in the next year, another one defaulted right here for about 50%. And basically, this is the total loss that they had and an amount of interest here. So, how do they make out? So they had 37,000, and for a bank, how would they get this money? For a large bank, they can simply borrow it overnight or provide the credit for it at the overnight rate, which is right now 1% about, or even less. And so most expensive is 1% times 3 years. So it cost them $1,100 to fund these loans if they were just to borrow the money. This is how much interest revenue they had, right? This is how much interest revenue they had. And the losses came from here, which is like the total loans that, they're not going to get this money back. So that's a write-off. This is called a write-off or a charge-off. This is non-performing loans. And this is what it's all about. They want to limit this. They want to limit these losses. And then this is the total funding cost. This is the total losses. So this is the total cost. And this is the total revenue less cost. So they made $19,400 on these less various costs. Now keep in mind they also have office costs, employees, buildings, equipment, technology, HR, shared services. So this is not the full picture, but for the purpose of just really looking quickly, how can they limit these losses? And my question for you further to explore is, what is really the default rate here? Because this is 3,500. I said defaulted, so 3,500. What is really the correct rate of 3,500 out of 37? On average, for credit card loans, what is the default amount? I think I saw on one of our slides that about 7-8% of credit card loans are non-performing right after the crisis. So this is not too far off, which is, I think, higher than usual, actually. So yeah, check this out. Do a little bit more research. It's obviously not a bad business for the bank, but you have to do a lot of modeling, a lot of work to get comfortable with this.